All right, so once again, we're looking at how you can save money on your taxes by lowering your tax bill or increasing your refund. This is the third video in a 4-video series on tax planning strategies. So if you haven't watched the other 2 videos, please go check them out. And let's get into why these tax planning strategies work, specifically today, how we can save money by shifting our income. Let's get going. My name is Steve Hunt. I'm a certified public accountant, and I'm the consultant for prosperity and adventure. I am the expert at helping people like you reach your dreams faster. And I'm the owner of collegetaxrefunds.com, where we help recent college students and their parents and families to claim thousands of dollars that they don't even realize they missed on their old tax returns. So if you have a recent college student in your family, please have them check out collegetaxrefunds.com and check the numbers on their old tax returns to see if they missed money that we can help them claim. So today, again, we're talking about tax planning strategies. How can you save money? Now, in these videos, in this 4-part series, I'm actually giving several tax planning strategies, some ideas that you might be able to use, but I'm trying to help you understand exactly why these tax planning strategies work so that you can better think of your own tax planning ideas and apply them to your own business or your own personal life. So again, you can follow the treasure map that is the Internal Revenue Code to create more after-tax wealth for yourself. And so today, again, we're talking about the income shifting strategy. Now, I've already done one video overviewing all of the general idea behind tax planning strategies, and I've done another video talking about timing, where you take income and your expenses and deductions in different tax years because not all tax years are created equally. So go ahead and check out those other videos if you haven't already. Go ahead and subscribe right now to the channel if you haven't, so that you can see other videos like this and videos that will help you create more after-tax wealth and get to your dreams faster. And please like this video and share with others. So we're talking today about income shifting. This type of tax planning strategy is based on the idea that not all taxpayers are the same, that it's better sometimes to have this taxpayer pay instead of that taxpayer. And so when you have 2 related taxpayers who are paying taxes at different tax rates, for example, an owner of a company and the company, or a parent and a child, and you have the ability to kind of shift some of the income and deductions from one taxpayer to another, then you can reduce your overall tax rate in the family or your overall tax rate for you and your businesses. That's the idea behind income shifting. And sometimes this works even with one business that is spread across multiple jurisdictions, like many states or many countries. And so, or even cities, if your city has an income tax in that city. I'm not going to go deep into detail about this jurisdictional one, but the idea is that if your business is doing business in multiple states, then you may want to definitely want to talk to a CPA specifically about tax planning. Don't just ask your CPA to do your taxes at the end of the year and say, hey, we did business in this state, in this state, in this state. Then there's nothing you can do when it's time to prepare the tax return. You're already going to pay taxes to each of those states, and you can't actually change the results. But if you talk to your CPA throughout the year about how to reduce your taxes, then one of the methods can be shifting your income and your expenses to different taxing jurisdictions. And so if you do some business in Texas where there is no income tax anywhere for individuals, I apologize, I can't remember if there's a business or a franchise tax there, but let's say you do business in some state where there's no business income tax, no franchise tax, and then you do other business in a state that has a really high income tax, then using some good tax planning strategies, you can identify ways to shift income into the state that has no tax or low tax and shift deductions or expenses into the state that has the high tax. And this will overall reduce your strategy. I'm not going to go into more detail on that, but please talk to your own accountant about how that might work for you. So let's talk now about how an individual person might be able to use these kinds of income shifting strategies. We're talking about shifting income or expenses between you and your business. If you own a business that is not reporting its income on your own tax return, okay, so it's not a sole proprietorship that's being reported on your Schedule C of your 1040. Instead, let's say you own an LLC that's been organized as a S corporation. No, I'm sorry. You got to forgive me for that one. It's not going to work if it's an S corporation because the income just simply flows to you on your taxes. But let's say that it's organized as a corporation. And so now it's doing its own taxes. So sometimes you can shift your income from the corporation, which might have a higher tax rate, to you, because you might have a lower tax rate. And one of the examples of doing that is if you have your company pay you a salary. By paying you a salary, the company that has a higher tax rate gets to deduct the salary, and you then include it in your personal income and you pay tax on it with the lower tax rate. You might also pay yourself rent. Let's say your company owns property. You might want to set that up differently. Talk to your attorneys and your tax advisors about making it so that you yourself on your taxes own that property and you report rental income from that property on a Schedule E. You might be paying lower tax on that income. And so if your company that previously owned the building now pays rent to you, they get to deduct the rent, reducing their high tax, and they get to pay you and you report that as rental income at a lower tax rate. And the same is true for paying interest. Let's say that your company has a lot of income and you don't really want to pay the high corporate tax rates on that income. You can loan your company some money for some reason. You could talk to your CPA about what that might be and then have your company pay it back to you with interest. This all has to be legitimate. You got to set it up right. Make sure that you're literally loaning them money and they're actually paying you back on a time schedule with interest. But now they get to deduct the interest as an expense, lowering their taxes, and you get to include it in your income and pay that tax on that income at a lower tax rate than the company would have. Now, another way to shift income between taxpayers is to shift it between you and your children or you and your parents. Now, if you have children or parents who are kind of depending on you, they're your dependents, then typically you buy things like their clothes and shoes, you buy their food, and you pay for their entertainment. Maybe you buy them toys, you might even buy them cars. You pay for their rent if they're living at college or maybe your parents' rent. There are a lot of expenses that you pay for your dependents that you don't get to deduct on your taxes. You don't get to save money by saying to the IRS, but I bought my child clothes this year, or I paid them an allowance this year. Those are non-deductible expenses. And so instead, if we can shift some of your income to your children, this is actually combining a strategy called conversion that we'll talk about next time. But because we're converting those expenses that were non-deductible expenses into now deductible ones by instead of giving them money for their allowance and buying their clothes and their food and their toys and their entertainment, let's instead hire them to work for us. Hire your parents, hire your children, teach them some good work ethic, and help them learn to take care of their own finances by paying them a reasonable wage for doing real work. You have to talk to your CPA about how to make this work, but they actually should be doing work for you and your company and adding value to your company, and then you pay them a real reasonable wage for the work that they're doing. And then you tell them, okay, you get to take your salary, keep track of it yourself, learn to handle money yourself, and you get to spend your money on your own clothes and on your own, maybe not food, but food eating out, on your own entertainment, on your own rent if you live at college or you live away from us, on your own utilities in that case, on your own whatever, your car, your gas, everything. Let them take it out of their own money that you're paying them from the business. And see, now every dollar you pay them in the business is deductible to you and you're lowering your income and paying less taxes. Meanwhile, you're not paying for all of those things that you were originally paying for that were not deductible. So you see, you've made it deductible and they will now report that income on their tax return. Now the trick here, or what's interesting, is even if you still give them an allowance and you still pay for their entertainment, you still pay for their toys, and you still pay for their clothes, but you just start paying your children for doing work in your business, you're still using this income shifting strategy because you get to deduct, say, the $5,000 you paid them this year, and you don't have to pay tax on that. They have to pay tax on it, and because that may be the only income they had during the year, they're going to pay a lower tax rate. Now, again, same is true if you hire your parents, okay? Now, another way to shift income to your children or your parents is by giving them a money-making investment, like a stock or ownership in your company, or ownership in some other, I don't know, collectible, something that appreciates in value, some bonds that are paying interest. Okay. Now, the trick here is that you can't just simply say that the money goes to them and it goes on their tax return. You have to actually transfer them the stock. It has to belong to them. And then they can report the dividends and the interest on the bonds, and they can report the capital gains on their taxes if it really belongs to them. So again, talk to your CPA. You want to do this all above board. But the point is, if that income is something you were going to give to your parents or your children anyway as like an allowance, and now instead you give them an income, a money-making investment, well, you now no longer have to report the money that you would have reported on your tax return when that income and dividends came, and that interest and dividends came in, and that your children can report it on theirs. Now, there is a trick to this, and this is why you want to talk to your accountant before you follow this strategy. And that is, there's something called the kiddie tax. This is where if your children have a larger, sufficient amount of unearned income, in passive investment income like this, the IRS Congress has decided that they don't want parents to be able to just give a whole bunch of investments to their kids and pay a lower tax rate like I just explained. They actually don't like that if you do it a whole lot. And so you'll have to prepare a special kiddie tax form where they calculate the tax on that investment income at the exact same rate as it would have been if you had just paid it yourself. So this doesn't always work. It is a strategy to an extent, to a limit, but please talk to your advisors, your tax advisor, about whether or not it will work for you. Now, another income shifting strategy where you take income that you would have had to report on your taxes and shift it to someone else is gifting appreciated investments, property, stock, assets to a charitable organization. Now, normally when you're shifting income from yourself, you're shifting it to another related party, someone that has a lower tax rate, but yet you're still keeping the money in the family or in the family business or whatever. In this strategy, you're shifting the income from the appreciated stock and giving it to charity because you were going to give them money anyway. So if you were planning to, let's say, donate tithing to your church or give a large amount of charity to the Red Cross, one way to do this, instead of giving them, say, $1,000 in cash, which is $1,000 that you had to earn in your job and you had to pay tax on before you could give it to them, then you gave it to them and you got to deduct maybe that $1,000. This is even better because now in that first scenario I just explained, you don't actually have to pay tax on that $1,000 because you earned the income, then you gave it to charity. But it's even better when you give them a stock that is worth $1,000. So you're still giving them exactly the same amount. They can turn around and sell it. They're getting exactly the same amount. You are essentially giving up the same amount. I mean, if you give them $1,000 of cash versus giving them $1,000 of stock, isn't that basically the same thing? As long as you were going to sell that stock anyway, okay? You're giving them $1,000. But in this case, let's pretend that stock was originally purchased by you for, say, $200 years ago. It's gone up $800 in value. Now, if you were to sell that stock right now for $1,000 and then give the $1,000 to charity, you would first have to pay tax on the $1,000 and then pay tax on the $800 and then deduct the $1,000. So you're netting a deduction of $200. But let's say instead you don't sell that stock and don't give them cash, but instead you just give them the stock with the $800 gain that's worth $1,000. Now you've still given them the $1,000 and you still get to deduct $1,000 on your taxes, but you do not have to recognize or include the $800 gain on your tax return. So your net deduction is a whole $1,000. Your net deduction is not $200. You're actually deducting the full $1,000. So that's one way of shifting that expense, shifting that income, the capital gain that you would have got on selling that stock, shifting it away to the charity so that they report the gain. But since they're a charity, they probably don't have to pay taxes, and you do not. All right, finally, one other way to income shift is to turn your sole proprietorship, sorry, this is blocking the screen here, turn your sole proprietorship into a corporation, or turn your corporation into an S corporation. The idea here is that if you're running a sole proprietorship, all of the income from that business is getting reported on your own tax return. And you're paying not only income tax on it, but you're also paying self-employment tax on it, which is a high tax rate. And one way to shift that as a tax planning strategy would be to create a corporation for your business. This might work, but it might not. You need to talk to your accountant about it because your corporate tax rates might be higher or lower than your individual tax rates. So if you create a corporation and the tax rates are lower than your personal tax rates, you're going to be saving money. That would be the overall total tax rates of the corporation plus the double taxation dividends tax. Again, this is complicated stuff and you want to talk to your CPA about it. And then it's also possible, though, that you might have a corporation that's paying higher tax than you would be if you simply put all of that income on your tax return. So in that case, you might consider taking your corporation and making it an S corporation, where all of the income now gets reported on your tax return and you pay a lower tax rate. Again, that may or may not work. It all depends on tax rates. This is income shifting, and it's definitely something you want to talk to your CPA about. So if you're looking for ways to save money on your taxes, one of the methods that you can use for tax planning is called income shifting, where you shift the income or even the deductions from your corporation to you, from you to your corporation, and report that income with a different taxpayer. Maybe you report it on your kids' taxes or on your taxes, your parents. All of these things are possible, as I've described in this video, but you need to talk to your own CPA, your own certified public accountant, or in my case, consultant for prosperity and adventure, about whether or not this will work for you. Thank you so much for watching this video. There's one more video in this series about tax planning strategies and understanding how you can save money on your taxes. Please put your comments your questions and comments down below. I'll try to answer what I can, maybe even create a video for you to answer some specific question if I think it applies to lots of people. Thanks so much. Have a great day.